Diamonds may be a girl's best friend, but friends can be fickle. You see, diamond prices have lost their sparkle, while gold, which has endured as a store of value for more than 4,000 years, is making new all-time highs. And today, that lesson matters deeply for Canadian investors, because the assets we once trusted most, bonds, may no longer deserve that trust. Let's start with diamonds. For decades, De Beers controlled nearly 90% of the global market. It was the ultimate cartel built on scarcity and marketing. But within a century, that dominance collapsed, and diamond prices have been in decline ever since. Gold, on the other hand, just hit another new all-time high. In contrast to diamonds, gold isn't built on marketing. It's built on geology. Its supply grows just 1 to 2% a year. Those facts are what makes gold reliable across the centuries of commerce, immune to inflation and political interference. Turns out, central banks can be fickle too. Despite gold's storied record of inflation protection, central bankers have reduced their holdings consistently up until recently. Amazingly, the Treasury Department in Canada directed the Bank of Canada to sell off its remaining reserves of gold in 2016. Back in 1965, we held over 32 million ounces. At today's prices, that hoard would be worth about $157 billion, more than the Bank of Canada's entire current reserve holdings. While Canada abandoned gold, central banks around the world have been doing the opposite. They've been adding gold steadily, reversing decades of US dollar dominance as trust in treasuries erodes. This isn't just about diversification. It's about survival in a world where access to dollar reserves can be weaponized. Why is this happening now? Well, because bonds, the backbone of reserves for decades, are breaking down. That's right. 30-year government bond yields are now at 20-year highs. Here in Canada, we're staring at a $100 billion deficit, quite likely, and over $300 billion in refinancing needs this year alone. That means more issuance, higher yield, and more strain. This isn't just about inflation. It's also about credit quality itself. Even in Europe, officials in France have raised the unthinkable, that a G7 country could one day face outside oversight, invoking the IMF as a cautionary example. That's how fragile sovereign debt markets have become. But here's the flip side. When bonds falter, gold shines. And this time it's not just bullion. Gold miners are finally catching fire. That's the leverage effect. When gold hits new highs, miners' costs stay relatively stable and their margins expand dramatically. After years of underperformance, gold equities are once again rewarding investors, and they remain a tiny share of the major indices, meaning the potential rotation into that sector is enormous. This is the dynamic we highlighted in our Prometheus portfolio, substituting hard assets and digital gold for bonds. Reducing reliance on bonds is no longer contrarian, it's becoming necessary. The numbers speak for themselves. Over the past 5 years, Canadian bonds have lost about 4.5%. But if you adjust that for inflation, the real loss is closer to 24%. Meanwhile, high dividend-paying Canadian equities have more than doubled. For decades, the industry equated bonds with low risk. But today, they look more like diamonds, an asset whose reputation has outlasted its reality. Let's be honest, this is a little uncomfortable. Here's an admission. My entire career coincided with the greatest bull market in history for bonds. Until 2021, interest rates had been falling for 40 years, cementing their role in balanced portfolio and crystallizing our belief that they are low risk. It wasn't that way in the 40 years which preceded, and it may not be for the foreseeable future. Look, we're not saying there's no role for bonds, just that we need to be more discerning in how much and where we own them. We'll talk more about that in coming videos. Our family serving your family. That's our motto here at Evans Family Wealth. I'm Glenn Evans, and we're here to help.